Is volatility about to make a comeback? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Cem Karsan, founder of Kai Volatility. Hey there. Great to have you back on.
Thanks for having me. Always fun to be back. Happy New Year.
Yes, same to you. And we were discussing right before we came on, but it just feels like we all got shot out of a cannon. It has been it's been busy from the beginning of this year. It's been a really busy week that ended with a ton of news on a Friday. We had the Supreme Court upheld the ban on TikTok. We can hear every Gen Z screaming in agony right now, maybe more than Gen Z. DC's getting ready for the inauguration of Donald Trump. The president-elect spoke with the Chinese president today. We had stocks rallying, treasury yields heading lower. It's also an expiration, which I know you track really closely. So what do you make of what's happening? What did you make of the action today?
This is exactly where what we would expect to happen. I would say it's a little bit faster, but it always tends to be a little bit more than you think. We were very adamant starting in mid-December that the market was topping in the short term. Despite all the positive flows that we had seen November, December, and all the rally post-election that we had talked about, markets were flagging in December relative to the size of those positive supportive flows. And so going into DSOPEX, it was clear that that was a good opportunity to make the turn. And we've been very bullish all year, and we got very, much more bearish there publicly. And that was right on cue. A day or two later, we turned over and dropped. And we thought January 13th, which we put out there in the Twitterverse and everywhere else a month plus in advance, would probably be the day we filled the gap to the pre-election. We did that to the day. And then the call on that would be a bottom, and that we would look to buy that at least until near February, early February to February OPEX. And so the question now, really just short term, we're really starting short term. We'll get to the big macro picture this year, years to come. But from a flows perspective, after this kind of knee-jerk rally that we're getting, that has been kind of on a Friday, not surprisingly, people don't step in front of it, but that has been exacerbated by all of the news that you might expect. Everybody makes this out to be new news. Nothing was new today, really. You get kind of this outcome today. I'll highlight that we're sitting right up against the 1.5 standard deviation of the 20-day. It's a critical kind of point. The fact that we're not continuing to push dramatically higher from here to 2.5, 3 standard deviations. If we are sitting here come Monday and not pushing to significantly new levels above this, that's a new flag, and that you should be watchful for a resumption of decline. We need to hit new highs and meaningful new highs from here if we are going to continue this rally. And our view is that this is really a counter, even though it feels like much more right now, really just a counter trend rally in the context of what is really a supportive set of flows broadly that are now fading. So the trade at this point, in our view, is in the absence of some liquidity bazooka, for lack of a better term, something where the Fed does a 180, and then all of a sudden, and you got some clues that that's possible. I don't want to make that sound like unlikely, but if Trump at all really pushes the Fed, and all of a sudden there's a surprisingly dovish Fed in the context of sticky inflation and a market at all-time highs. Unless we get that, I would expect, if it's just a coming Fed meeting of hey, we're going to stand pat and watch, I think this market is likely to fade. And I think when I say fade, I'm not expecting anything critical in the first half of this year, but I am looking for a very wide chop. And I think we revisit lower lows than that November gap fill, likely in the 5,500 in the S&P, down all the way potentially to 52, somewhere in that range. And we probably see that in March, around March OPEX. And that low will then probably lead to another massive rally near the highs again. So I think it's just a lot of really wide chop. That's a 10% plus
Yeah.
drawdown from peak to trough, followed by a 10% kind of type rally. And I think it really lines up with likely happening into March OPEX, and then a rally out after March OPEX is kind of what we would expect in that scenario. So people would then say, okay, maybe we get a minor new high there and people think we're back to the races, kind of like they feel like they are now. And then again, I think that one fades again, and that will be the last one. And is that in May? Is that in June? Is that in July? Not sure. We'll watch and see. But we really think second half of this year, or approaching second half this year, is when we finally give up a topping process, and that's what this is. Tops are a process, bottoms are an event, and our view is that this is broadly a topping process that we are starting now.
That's so interesting. So two things. A lot of, and we've talked about this before, and I'm not discounting the fundamentals at all, but I think it's always important when we talk to you, because you're looking at other parts of the market that are driving action, because we tend to assign too much to a headline. And so, the narrative out this week was we had the combination of really strong financial earnings and benign inflation, and that's kind of what's created this rally. Um, yes, inflation was a little bit better than expected, and the financials, the earnings coming from financials were good. But do you see this more as a function of flow as opposed to those news events, or did the two just come together nicely to?
Yeah, everything fits together, but it's important to note when we're talking big picture things like what's the 10-year doing, and what's the Federal Reserve going to be doing in terms of liquidity, what's the Treasury doing, what's going on with U.S. versus China, like those things all matter, and they matter over periods like a year, 2 years, etc. Right? And so when you have an incremental change in a view or some number that comes out that gives us a clue about that, those things matter, but they matter for the weighing machine, which matters a year, 2 years, 3 years out, right? And people assign value to that on the day of
Yeah.
it happening, as if there weren't expectations already, or that these are incremental changes on big picture things, and so they matter, and they matter in the long run. But the amount of flows and price action difference that happens on that day as a function of that, relative to the positioning and what that means for the outcome that day, what options what's expiring today, and how much volume is that generating, and buying demand, selling demand, like those things on a daily, weekly, monthly basis are way more important to price action, and the two interact, right? Because if you get good information and there's already positive flows and short gamma, then guess what? It's going to squeeze. But the real point was there was positive flows and there was short gamma, and it was probably going to squeeze anyway. Maybe it changed the rate and the trajectory over a day versus a week, et cetera. So yeah, you have to look at both. But the flows are kind of immutable to some extent. Supply and demand that comes off of those is very, the framework that comes from that is not going to change, and the news interacts with that. And changes it one way or another, maybe the path that those things play out on. But so positioning is critical over the short term, and I
Yeah,
would
and you
argue
brought up the
by
point
far the
that
most important thing
these
over some
markets are
short term.
just getting bigger and bigger, right? Like the options and derivatives markets have a lot of participants, and they are playing a huge role. So you have to be aware of what's going on. What about sentiment? What does positioning tell you about sentiment? I had someone say um, earlier in the week or last week that the range of possibilities or probabilities are so wide, because there's so much uncertainty with the new administration and all the things that could possibly happen, and yet the market that is skewed has an asymmetrical skew. Everybody is long equities and everybody's bullish and thinks this party can continue. But I have to tell you, I get a lot of messages from people who seem very worried all the time and are constantly saying, "Should I lighten up on equity? Should I get out of tech?" So that's just anecdotal. But what are you seeing in terms of what the money is doing? Are people, for the most part, still very concentrated in bullish equities, or is it a little bit more even?
The numbers lay out that household equity allocation is dramatically higher than it's ever been.
Hmm.
So that's just fact. Something like 50% of all assets, are in stocks for your average household. It's I think 47%, which is dramatically higher than we've seen historically.
Mm.
So yeah, I mean, people are very allocated. Private equity, venture capital allocations, relative to 10 years
Everybody's
ago.
at the same party,
Yeah, everybody's at the same party.
which makes me
So
nervous.
yeah, there's no doubt about that. There's definitely some exuberance with the new presidency and a view that that's likely to be a very market friendly. Um, very well is maybe true and is likely to be true. Um, there's some worries about the inflation piece, no doubt, and understandably, there's concerns by people in the know that the valuations are wild, right? Like historically high, like dramatically high, like only rivaled by the tech bubble, and you could argue relative to the tech bubble, given where interest rates are now,
Yeah.
even more expensive in some ways. Definitely price to sales more expensive, and so there's reasons to be concerned, but this if you go back to what it felt like in 2000, it's not that or 99, it's not that different. It really isn't. Yeah, everybody was worried. Smart people were really worried in 97, 98 about a crash, right? Because valuations are crazy. You always have people who are smart and see the writing on the wall. Like we talked about a housing crisis in 06. We talked
Yeah, the
about a tech
timing of it
bubble
is
in 98, right? But both led to rallies before they declined, and but people were all in 98, you better believe, and even more in 99,
mm,
um, and so there's an interaction between the bulls and the bears there. That's part of what leads to the blow off top. Um, uh, so I think there's a real, and people have seen this movie before, so there's a lot of people who at least appreciate that a blow off top, a fast move is a high probability. That's one of the big definite paths that we're looking at this point. There really are two major paths and ways this plays out, and it's not a tech bubble as much as there's some parts of that, but it's also something pair that with 1968, and a populist kind of inflationary push, and that is a very different thing than we've ever seen, and that can end in one of really two ways, but it doesn't end well.
I
And
want to break down those two possibilities since you said they're kind of two paths. Before we do that, though, uh, a little bit more sort of near term. What about treasuries? Because part of what you see today, and part of people talking about stocks doing well, is the fact that treasuries have come off, yields have come off a little bit, and there was so much conversation about the fact that yields continue to move higher, and we had people talking about 5% again, even though the Fed is not talking about hiking rates. So the market's kind of worried about inflation, not really responding to the Fed ever since they cut, and has been moving. Yields have been kind of persistently higher. Seem like that edged back today. Does it seem like maybe that's the new direction, or are we going to continue to see this upward pressure on
yeah,
bond
things
yields?
don't go in a straight line, and there's the weighing machine and there's the voting machine, and guess what? When everybody's talking about inflation going higher, the voting machine has a lot of people who are hedging for it that need to get washed out a little bit. So in the short term, again, I want to be very clear. We have since 2021 early 2021 pounded the table that interest rates in the long end of the curve were going higher. And every single time they rallied and then they pulled back, everybody goes, "Told you so," and then they run again, right? We've had transitory inflation for 4 times now in a matter of 4 years. It happens every year. It happened 3 months ago, right? And everybody said the same thing. And we said, "This is your opportunity. By the end of the year, they'll trade 5." And we missed it by 10 days. But, they screamed over 1% in 3 months. Yet, oddly, people see a little bit of a pullback from those near term highs and like, well, I told you. And that probably does mean it digests. I think we've been very clear that this is not going to go to 6.5 directly from here, just like it did in the last 3 months. It's going to likely happen in the back half of the year, but maybe a little bit sooner. But again, I think if you're sitting here after a 3-month move of over 1% higher, and saying we can't trade 6, which is again just 1.25 higher from here. After, by the way, we've moved over 4% higher over the course of 4 years. You're missing what's happening. You're kind of whistling by the graveyard, and 9 out of 10 people think I'm crazy to call for 6%, because how could the market, how could our debt manage to handle 6%? But wasn't that the case from 4 to 5? Like, and by the way, when it goes 6 to 7, that will also be the case. And it's not going to be a straight line. But when everybody loses, and you stop hearing about this inflationary talk, and by the way, we've been talking about it for 3.5, 4 years. That's when you want to get back in and really push on it. And my view is it's going to more. You're not going to get a 1% pullback this time. Mm-hmm. I think take what you can get. I think you're going to get a correction in time. I think it's more likely to just digest for a while. But the reality is the curve is no longer inverted. And whereas it was a lot easier to trade the last 3 years to pound the table from a trade perspective, to say, hey, you get paid to take on this bet, that it's a hedge broadly to so many risks in the market. And again, everybody point and say, well, the pricing says you're wrong. Well, the market was wrong. But now, it's not that easy. Now you got to buy a higher yield. You got to, you have, or sell bonds at a more of a discount, and break evens are higher dramatically. So, and you don't get paid to hold it. You got to pay to hold it. So there's a real cost. And from my experience as a market maker, as a trader, the harder trades, those are the ones that work. Not the easy ones rarely work. And when the easy ones work as well as they have, when that trade gets hard, that's when it accelerates. So it's getting harder to hedge inflation. It's getting harder to hedge long-term duration going higher. And I think that's exactly the time you want to be pushing on this. And I think there's so many reasons, given the new administration, that seem obvious, but people seem to make up excuses why they're not important, that are just a continuation of a bigger populist picture. And I think we really need to be.
Yeah, and I have to say that has been something that has come up with so many. Well, it's not mainstream, but certainly a lot of the people that I talk to who are taking like a big macro look. There's a lot of concern about that, and the fact that it's sort of underappreciated, and people tend to think it's about what's happening in their vicinity, but it is this global trend that's going to fuel inflation. A treasury, the long end of the treasury at 6 or 6.5. I mean, as you point out, we haven't seen that in a long time. People are not used to that. Does it break something, Cem? I think people think it's not going to happen because something will break and the authorities will somehow rush in.
It will happen. It will break things, and then authorities will rush in. I do think that we don't get above 7 this year. I don't think we probably hit 7, but we could. I think it's more likely 6.5-ish, maybe 6.75. I don't know, somewhere in that region. It starts to really be a problem. It's not, by the way, just a problem in price. Again, I think this, and the people who are listening here know me, know that we really think about way more importantly than price is time, or as important as price is time. The reason charting and technicals work is because you draw a time component. And options are a 3-dimensional surface that incorporate time. So time, you can get a correction in time. You can get effects where if yields go to somewhere for some amount of time, then they start to really affect and be more painful. So I think it's not just the pain that's coming. It's not just that yields are going higher, which will be part of it, and particularly the long end of the curve, right? That's the critical part, because that's where the duration is the most painful. But importantly, it's 4 years now since we bottomed. So if you locked in rates near the bottom or a year after the bottom, you have less room. You're running out of time. And there's a lag to monetary policy, particularly this interest rate piece of monetary policy. And there is so much supply coming onto the market this summer, not just from refinancing, but really from venture, from private equity. There's so much, IPOs, everything. Everybody needs to come access markets, and it's happening more and more. And never mind the Treasury, right? The Biden administration didn't do the Trump administration any favors by financing everything at the short end of the curve, because at some point you would think that we need to go out on the curve a little bit if that keeps getting worse and worse, right? And then who's going to provide that liquidity? So there's just so much coming on, liquidity coming on, so that or lack of getting pulled out, I guess. So much supply coming on the market that you have to really, really worry about these yields going higher, particularly now that they're not easy to hedge and they're expensive. So that's our view. I think that's bad for equities as well, obviously. But that's the weighing machine. And there's a path, there's several paths that can take us there, several timelines. It doesn't have to happen middle of this year. Like I said, if there's a really aggressive, proactive, I want to be focused on that word proactive. If Trump and the administration come in and pressure the Fed, and the Fed all of a sudden you start hearing things, you're like, where did that come from? And it will be coming from on the other side of from the executive branch. If they start all of a sudden being very dovish in the face of market highs or near market highs and relatively hot employment picture, they can keep the plate spinning. And that's the blow off top scenario. That's the scenario where you see a 2000 type kind of, maybe, not multi-year, but you really see another 10% plus in the market before this ends. And that will be a market up event, that will be, that feels, people have felt this before. So I think that's natural that people are gravitating towards that's the most likely scenario, because we've seen it again and again. And that just feels like the most likely scenario, especially given this administration is here. That's part of why I actually am thinking that's not the most likely. And I actually think there is because interest rates can continue to move higher without that, I think you could see a scenario where you don't get the liquidity, interest rates still kind of go sideways to up. And then eventually here, maybe not hitting 6.5, but maybe just 6 or so in the middle of this year. Then the market itself takes down the economy, and then yields kind of really come down from there in the short term as we enter some type of recession in Q3, Q4. I think that's actually the most likely path. And I actually think that would probably be a 30-40% decline in markets, not this year, but by March or June of next year. I think that you'd have a 9-month to 1 year type outcome, which we haven't seen in quite some time. But less bad than what will happen if we see a 10-15% rally, and then see this in September or January of next year. So those are kind of the two paths, and again, they're really tied to monetary.
You choose the pain. It's like drawn out and it's slower, or it's like this rocket up, and then we still get an awfully harsh reaction.
You can change the short-term trajectory with supply and demand imbalances, right? You can push liquidity into the system and try and keep the plate spinning. Eventually, it doesn't end well. The question is, how long will they keep the plate spinning, given where we are? We've had 2 years, 50% returns. That's also not a good harbinger for future returns. There is a mean reversion that tends to happen given these valuations. I think all those things point to the much higher probability being to some type of kind of topping process, as I've kind of highlighted here. That doesn't mean today, tomorrow we're topping. It means that we are, watch the price action near the highs. And if we can't meaningfully get through those highs, and the liquidity isn't pushed in to get us moving through those levels, this will eventually not end well. But it's a function of time, and it won't be easy. It's going to bleed out people who are just buying vol outright. It's going to make shorts hard. And then eventually, when people least expect it, you'll get some big reversal and it'll begin. But again, I don't think that happens for another 6 months or so in terms of the bigger move. In the meantime, we'll see some real, go nowhere but chop. So everybody, if you're long calendars, which is ultimately the right trade, you're long vol and long things for what's coming in the back half of this year and the following year, which is really what you want to own in terms of volatility and protection. But if you're short the stuff in the short term, which ultimately is, again, the right trade, it's going to be hard to hold because you're going to get whipsawed each way. And that's probably the most likely outcome. Just a lot of chop, go nowhere for 6 months, and then ultimately a topping process that leads to a bigger decline, later this year or next year, depending on how this price action plays out with the Fed.
Yeah.
With the liquidity of the Fed.
I mean, so much good information there, and there are a lot of unknowns. And this is a really good time, by the way, with that risk. No matter what you think and whether you agree with Jim or not, this is a time to look at your risk appetite. Right? When do you need your money? How much can you afford to lose? Are you comfortable with the potential for any of those scenarios to happen? And if we're chopping, you'll have an opportunity to readjust your portfolio for the risk that you really can tolerate. I think that's a really important thing to do right now. A couple of things I want to squeeze in. So a lot of hi everyone in the chat. We've been so engrossed in this conversation. I haven't said hello, but so many good comments coming in and a lot of people pointing out, Jim, and I know you're thinking about this. So if that is all true and we see that upward pressure on interest rates, this is when the government gets creative. And yes, maybe they pressure the Fed, but maybe they do all sorts of other things too. I don't know if anyone was watching Scott Bessent's testimony, nerd alert, but I was. And it was really, really fascinating. And there's going to be an enormous amount of pressure on this guy to try to manage this. Not only the administration's relationship with the Fed, but just manage what's potentially coming down the pike if Jem's right. And so a couple different people saying, they're a dollar bear. Ched said, great question. If 6 to 7% breaks everyone, but are we factoring Bessent as a dollar bear? I think meaning could they devalue in some way? Someone else saying, wouldn't they just do yield curve control? Is there a possibility that they, and somebody else mentioned Ben Bernanke once said the Fed has a great tool, a printing press. Can they do things that will potentially like some creative, instrument or policy that will prevent those yields from rising so much? Or does it just postpone the
So everybody that's in the chat and anybody, most people who are in these markets, including myself, candidly, haven't lived through a period that is different than the last 40 years, right? The ability to control things with monetary policy exclusively was very easy because the Fed was dominant during the last 40 years and didn't have to worry about government interfering. Government didn't do anything because there's disinterest. We had a deflationary environment for 40 years. How did that happen? Because monetary policy drove a structurally deflationary period. It also drove inequality. And anybody who grew up during that time, those 40 years, had this experience of massive inequality. The system's broken, doesn't work for me, right? All the things we've talked about, right? And now those people are coming to political kind of dominance. And they have actively, for now 8 years, voted for policies that help the middle class, the median outcomes. And so if we are going to prioritize median outcomes as opposed to just maximizing GDP, right? If we're worried about money no longer going to the top, but doing things that are more fair, which is what the policies have been, right? We'll see if Trump continues those policies. But if we're going to continue that, that is inflationary. It's not deflationary. You cannot have monetary policy pushing massive stimulus while we are also pushing massive stimulus on the fiscal side. I mean, if you do it, that's fine for debt, and they will do it, to be clear. But from a cyclical perspective, if you're cyclically stimulating while you're from a monetary perspective, while you're also naturally already fiscally stimulating. It's already in the pipe. It's not about doing more. We're driving tons of money to people. You think inflation is bad when interest rates have been moved from 0 to 5. What happens when interest rates go from 5 back down to 3 or 2, right? In the face of more fiscal spending, right? Without a recession, that is cyclically inflationary as well. So short term, that would be very inflationary. They can try, to control things with more monetary policy, yield curve control. By the way, to that end, that's another issue, right? Yeah, could they do that and just structure yields higher? What people don't understand is that if you lower artificially long-term interest rates lower, that is the most stimulative thing on the planet, right? Because you are then, again, in the face of inflation, you are saying, here, people, take money imagine a scenario where inflation is 5%, right? Which is where services inflation is. And imagine now you can borrow money at 2%. What do you think markets do? Markets, everybody in the planet borrows at 2%, leverages, right, and buys everything pinned down. What does that do to inflation? Makes it worse, right? If you put more money into the system, that creates more assets chasing more money, chasing less assets, and that's what we know. We know that at the end of the day, that you cannot artificially lower long-term rates in the face of inflation. If you do, you make inflation worse. It's pretty straightforward. And arguably, and this is what we argued publicly for the last 6 months, if the Fed was going to actually be aggressive with monetary policy and try and push rates lower this time around. Again, everybody, by the way, when they heard that the Fed was lowering rates, thought, oh, this is great for the long term, the long end of the curve, right? We were adamant. We said, no, it's exactly the opposite. It's actually inflationary. It's going to make the 10-year go higher, not lower. It's counterintuitive to people who just see the Fed as controlling monetary policy. But the Fed does not have control of the long end of the curve unless they do something like yield curve control. And you better believe they can try and hold it down, but there is going to be a massive, massive problem with inflation if they do that.
Yeah. And it also reminds me that, like, in the technology-driven markets we have, if you try to make a stand like that as a government, the market will go after you until they break. I mean, that we have history is full of people taking a punt on that when the fundamentals don't support.
There's an op-ed. I encourage people who subscribe to Barron's to read it. This last Barron's, which I think is an excellent comment. There's a saying of the fourth estate, which is media, right? Media can control. They're like the fourth branch of government, basically. They can control, in theory, some of the things that are going on in the other branches, right? And they argue that there's actually, and importantly, like the Trump and everybody can try and control the outcomes. And the fourth estate, they may not even be as powerful anymore, but there's a fifth estate, and that's markets. And markets can, they can try, and they think they can control everything. They think they can make things go the way they want. They have a lot of influence, but markets have a funny way of holding people who don't have good, sound policy, right? They're holding their feet to the fire. And I would argue that the fifth estate, the markets, are going to make it very hard to do some of the things that Trump et al. Are looking to accomplish over the next couple of years.
I think that's such an interesting comment, and we've seen it. At least they speak the truth, I mean, or a reality that might be different from the controlled message that's trying to come. We saw that during the financial crisis when Congress was arguing and voting down the relief. The Dow dropped 1,000 points in like 5 minutes. I was watching it live, and the market let them know exactly how they felt about their policy in real time. So we have examples of that happening. There were such good comments in the chat. We've got to go, but we're going to continue this conversation with Cem. It's really important to lock your mind around this. And some people are saying, oh, well, if interest rates are that high, my first mortgage was 9%. All of you smart people pointed out that yes, it was, but the price was lower. So not apples to apples, as Jim points out. And I would add, we've psychologically came from a decade of zero rates. So it's very different when you're used to interest rates being like that. There's a real psychological shock to people who now have to pay up very quick in very short amount of time. So these are really important conversations to have. We're going to release an interview Sunday with Russell Clark, who's talking about this global paradigm shift. And he sits outside the US. He's watching different things, but a lot of what he's saying is aligned with what Jem's talking about. Very smart people who watch markets for a long time are paying attention to this. So I think it behooves all of us to really wrap our head around it. You can agree or disagree, but it's a really important conversation to have. And hopefully will give you some ammunition so you can make really smart decisions and not be caught off guard. You were very prescient, Jem, when you had that "Make Volatility Great Again" hat that I've seen you have on Twitter.
It's pretty clear that those supportive flows were dampening volatility. When you have this sumo market where you have massive flows on both sides, and then all of a sudden one of the sumo steps aside and said, "I'm not going to play anymore." Pretty clear which way the market was going to go. So vol was unnaturally compressed. It was bound to release, and here we go.
Yeah. Chad's asking markets. Are we talking about markets as in bond vigilantes? I don't even think we have to name it that. It's just, it can look like that, I guess, but
speculators, when they see blood, will. It's not nefarious. When there's an opportunity to push on things that are moving, that's what people do. That's what markets do. Markets find supply and seek out pain. That's just a supply and demand reality. It's not some one individual necessarily pressing on a string or pressing on kind of an opportunity. But I can call them vigilantes. They're speculators throughout the market. But they're not going to be the cause. They'll be the people will point at them. Trump will probably blame them. But no, it's a bigger structural issue. That's a function of supply and demand and a lack of people willing to step out and take the other side of that trade.
Yeah. And they usually focus on policies that aren't rooted in fundamentals, and they sniff that out and they go for it. Jem, great stuff as always. Thank you so much. Buckle up, everybody. Welcome to 2025. It's going to be a lot, but
it's a post-election year, right? We talked about the election years and how those turn out. Don't forget the big picture. We're back to a post-election year and a populist period.
And we're going to be talking about it a lot. We're going to release that interview with Russell on Sunday. I highly encourage you to listen to it. He says some really important things. He explains some things that you've all been asking about in the chat too, like how can we have wage inflation when we have automation? He has a really interesting answer to that I hadn't thought of. So check it out. Jem, have a great weekend. Thank you so much, and we'll see you soon. Everyone, it's markets are closed Monday, so have a great long weekend here in the U.S. Enjoy the inauguration if you're watching, and we will catch back up with you next week. Thanks, everybody.
Take care
and good luck out there.